Kevin Carter, founder and CIO of EMQQ. You're very welcome to the podcast.
Thanks so much. Glad to be here.
What part of the world are we speaking to you from? Or what part
I'm in San Francisco.
San Francisco.
Yeah, I'm actually 15 miles east of San Francisco, but San Francisco is my area.
And you are founder and Chief Investment Officer of EMQQ since 2012. Do I have that right?
2014, November 2014, we launched EMQQ.
Can you tell our dear listeners a little bit about what EMQQ do?
Sure. So my company's name is EMQQ Global, and E stands for emerging, M stands for market, and Q's stand for technology. So we are investors in the emerging markets technology sector, and specifically the internet part of the emerging and frontier markets. And so EMQQ is also the name of our primary index and the different ETFs that track it, both in the United States and in Europe. And that is a strategy that involves all of the emerging and frontier markets. There's 45 emerging and frontier markets. China, the biggest, of course, India, Brazil, places like that. And so that's our primary, strategy, and that's the universe that we're the first to define as a sector. And then we have two other strategies. One is the same thing without China, which is a U.S. offering with the name FMQQ, the next frontier of the internet, because as we'll talk about, China's an emerging market, but when it comes to the internet, it's the most developed country in the world. So these are the next frontier of emerging markets internet companies. And then we have an India-only strategy, IN as in India, INQQ, which is listed in the United States and also as a UCITS there in Europe.
Okay, excellent. So ultimately, for listeners, three funds ultimately offered by Kevin and EMQQ Global, tracking different sectors, ultimately different geographies, ultimately, right? But all emerging market oriented and tech side of emerging markets.
That's right. There's one universe, and then we just leave out China for the second offering, and then we just include India. So India is in all three of the strategies. China's only in one. And
okay. So in terms of scale, according to Yahoo Finance, anyway, you've somewhere in the region of 400 to 500 million invested across the three funds. Is that accurate?
I think between the United States and our UCITS, it's probably 600 or a little over 600 million.
Yeah. Okay, excellent. So what sort of a journey has it been for you guys, I suppose, since inception 11 years ago? Can you give us a brief synopsis of the journey?
Sure. Well, I've been focused on emerging markets for 20 years. So, my journey, at least the emerging market part of it, is about 20 years old today almost. And it started in China. I was working when Google went public. I ended up, becoming an advisor to a lot of the early Google engineers right after their IPO in 2004. And so I started going to Mountain View, in 2005 every spring, and I would help these Google people set up these portfolios, direct indexing, if you know what direct indexing is, I had invented direct indexing before this, and the Google people were interested in it. And so I had all these Google people that wanted to make their custom S&P 500 strategies. And then the first one said, well, can you manage all my money? And I said, well, I don't really do that. And he said, what would you do? And I said, well, I would just use a bunch of ETFs for the rest of your portfolio. So we'll make a custom S&P, and then for all the other asset classes, we'll find the cheapest beta, something I know you prescribe to. And when I started going to Mountain View, pretty much every week in the spring of 2005. My partner, Burton Malkiel, who you know of, he started to go to China the
Hmm.
same time that I was going to Mountain View. Two of his Princeton economist friends were Chinese professors, and they had been offered a lot of money to go back to Beijing around the year 2000 to teach economics there. And they started to call Burton and say, "Hey, Bert, you need to come see what's happening in China. Like China's booming. We're back. We're embracing capitalism." And the economy was growing at, 10, 11, 12%. And so he starts going to China when I was going to Mountain View. And him and his two friends wrote a white paper about investing in China. And Google called me and said, "Hey, can Burton come down to Mountain View and talk about investing in China?" And I said, "Sure. When he's in San Francisco next, I'll bring him down." And that was 20 years ago. I got in my car in San Francisco and I drove down the peninsula. I picked up Burton and we went to Google's campus and he gave a talk. And when he was done, all these people looked at me and said, "We want to invest in China."
Okay.
So I didn't plan it, but from that very moment until today, that's basically all that I've been trying to figure out is what's the best way. First of all, how in the world do you invest in China? And if you're going to do that, what's the best way? And so that,
Not an easy problem to solve or puzzle to figure out, right?
well, to be honest, it was pretty clear it was pretty clear pretty fast that the traditional way wasn't going to work. If you wanted to, if you just went and bought the China index or the problem in emerging markets is the index itself. What literally happened was Burton finished his talk,
Hmm.
and then we got in the car and we drove back to San Francisco. And I walked over to the portfolio managers and I said, "The Google guys want to invest in China." I said, "You give me a list of all the companies in the China ETF," because there was a China ETF 20 years ago, but there was only one.
Okay.
And it was the iShares FXI, which is the ticker, based on the FTSE Xinhua Index, which is what the F and the X stand for. So that was the only China ETF. And, I assumed if these Google people wanted to put a little money in China, that's what we would use. But while I've worked around indexing for 25 years now, I'm an Omaha person first. So yeah, I care about what are the businesses that we're going to own. And so I asked
Omaha,
for,
when you say Omaha person, sorry, just for clarity,
oh,
for some
sorry,
of the
yes.
listeners, you mean Buffett approach? Is
I,
that ultimately what you're
I'm
talking?
a Buffett and Munger, Berkshire Hathaway, when I look at the world for
Yes.
business or investment purposes, that's how I look at everything.
And when
And
you have that, when you're, I guess, educated, for want of a better term, by Buffett and Munger, and it's, you pick the business by business, how how did you make the connection between let's look at businesses to let's create an ETF that is a diversified portfolio of businesses within a particular economy or region?
sure. Well, I mean, let's first of all, let me, make, and I'm sure you and I'm sure probably most of your listeners are aware of this, but Warren Buffett is one of the biggest proponents of index funds.
Hmm.
And in fact, I was this young, idealistic value investor, in 1995. And, I was 25 years old or 26 and trying to learn everything. And I was, back then you call up Berkshire Hathaway and ask them to send you an annual report, which I had done every year since I got out of college, and I got the 1995 annual report, and I was reading it, and then I came across this um, sentence that blew my mind. It was Warren Buffett, my hero, my stock picking hero, said that most investors, both individual and institutional, should just buy an index fund, and that stopped me in my tracks, as they say. And then I did a little research and basically realized that that was mathematically absolutely true because the index fund is free essentially, and all of the other choices include a 1 or 2% fees and expenses. And so if the free market fund goes up 11% and the other guys that charge, say 1 or 2%, they're going to underperform by 1.5%. It's not even debatable. And so that kind of blew my mind. And so I became this righteous um, save the world, save the investment world person at that point. And I, um, had at first I started the first fractional share brokerage, so you could buy stocks in dollar amounts instead of share amounts, because that was the biggest problem back then. You needed to buy, if you wanted to buy stocks directly, you had to buy 100 shares, and the average stock was $30. So if you wanted to put money into the stock market, you needed $3,000, and the cheapest commission was $29. So it was a 1% commission to buy one stock, but some stocks were $100 a share. So that was $10,000. And so if you were saving regularly, on a monthly basis, which is what all investors should be doing, and you were in your 20s like I was, maybe you could save a few $100s. Well, that you couldn't put that in the stock market directly. You had to go through a mutual fund. And so to level the playing field, I first decided that we needed fractional share brokerage, which didn't exist. And I thought of it and found the people to help me build it and filed a patent on it and built a brokerage firm called E-Investing. Because back then, E-Trade was the hot thing and everyone was talking about trading. And I thought, well, let's not do that. Let's use this technology to let people invest better and build their own fund. In fact, that was the name of the product, Build Your Own Fund. And ironically, we sold it to E-Trade in the year 2000.
They rebranded to they brought it.
They did a lot of stuff with it, but they messed it up. And to their, they had a lot of other problems. There was the bubble was bursting, and it burst soon after that, and so they were. It became a low priority to them pretty quick because they had a lot of other issues. But they stopped offering it. I'm sure that I think every brokerage firm in the U.S. now offers this fractional shares. But like a lot of things, people said that's crazy. Why would you do that, right? And then that's when I hooked up with Burton Malkiel. That's when because he basically invented the index fund. Burton Malkiel did. And that's why A Random Walk Down Wall Street, his book, is so famous, because when he wrote that book in 1973, he suggested that his idea was somebody should make an index fund.
Yes.
And there were no index funds. And he actually in the book he said the New York Stock Exchange should do this as a not-for-profit. And apparently they were considering launching this fund, but they decided not to. And Burton's friend John Bogle did.
Yeah. And
so
that's one of the interesting things about Vanguard, isn't it? It's not for profit. What's the dynamic of that, do you think? And as they continue to evolve, and comment on that.
It has a lot of dynamics, to be frank, and some of which are obvious and good, right? As John Bogle liked to say, in the investment business, you get what you don't pay for, which means that if you don't have to pay someone, you get to keep the money. And again, because this investing thing ultimately is a simple math problem. You got to save as much money as you can and buy and hold and buy and hold and buy and hold and let the miracle of compounding work for you. And the length of time that you're able to, buy and hold is one of the pieces of the math. And then the other one is, what percentage do you get on average per year after fees and taxes? Like, what's your real total net return? And again, if the market goes up, say 10% on average or whatever time period you look at, Vanguard will give you 10%. That's what you'll get, essentially, right? And the other people that charge you a 1.5%, they'll get 8.5%, and that's a 1.5% difference. But if you do that for 10 or 20 years, it's not 1.5 or 10.5. It's like 3x your money.
Sure.
Right. And so what Vanguard has done, every dollar that it takes away from the Boston, the traditional open-end mutual funds is essentially passed on to the end investor, and that dollar amount is trillions of dollars. So that's good. Now, frankly, though, as a business person that offers, and a for-profit business person as most 99.99% of investment businesses are, it creates a situation where the different fund to get your funds approved at certain places, they'll say, well, your fees are higher than average, and you'll say, well, yeah, because this isn't a not-for-profit. I mean, this is something that I created. It's a better product, but so you're comparing me, and this isn't just me. This is all the other investment managers. Just based on that, it's sort of an unfair advantage. And the other thing about the not-for-profit element, which is I don't think very well known or understood. In fact, I don't think I can even say exactly what happened in terms of understanding it. But I believe when Vanguard launched it wasn't going to be that. But that John Bogle's position was at risk, and to defend himself, he converted it to a mutual company so that he couldn't be. I don't remember the details, but I don't think it was initially planned as this benevolent, thing. I think it started as a thing, and then I believe there was some corporate, issue that led to them making a conversion to this not-for-profit, meaning that basically the customers own Vanguard, and so the bigger they get, the lower the fees are, because they're not there to compete with the traditional for-profit part of the business.
Very interesting. So I'm interested to follow your thought process around the emerging market. So how did you?
Oh, okay. I got off track. So here's what happened. We got back to the office. I walked over to the portfolio managers, and I said, the Google people want to invest in China. Give me a list of all the companies in the China ETF, because I'm an Omaha person. And I don't care about the name of the fund. I want to know what are the businesses we're going to be owners of, because ultimately, if you buy an ETF of stocks, you will become an owner of those businesses. And so I asked for the list of companies that we were going to become owners of. What's in this ETF? There was 25 Chinese stocks. What are they? 25. And that's when Burton pulled me aside and he said, Kevin, when you get the list, you're going to see that most of them are Chinese state-owned banks and oil companies. And that didn't sound good for a number of reasons. But then Burton went on to explain to me that these companies were inefficient, which I think everybody would have probably expected, that they had conflicts of interest, and that there was a lot of corruption. And that when you boiled it all down, they didn't really care about the most important thing if you're an investor, which they didn't care about growing their earnings. And this made me sick to my stomach, because in Omaha, it's really simple. The reason any business, public or private, has value is because it makes profits for the people that own it. And the only way to grow the value is to grow the profits. And state-owned enterprises decidedly don't do that. And so I got kind of sick to my stomach, and then I got the list of the 25 companies, and 80% of it was state-owned enterprises. And so I was looking, before I even sat down, I was like, we have a problem, right? Because
you're not going to put your clients, as it was at the time, into this.
Well, it was the only option.
But right, so this was the challenge you had, right?
Well, that was, yes, and then the other thing that I noticed when I looked at the holdings is that it was less than 10% in consumer stocks.
Okay,
and I already knew that the thing that's emerging are 6.5 billion people, and they want all the things that you and I have, and so that's the story, right? It's 6.5 billion people that want more food, better clothing, heaters and air conditioners. They want to go to a movie, take a vacation, get on an airplane for the first time with a $19 plane ticket. They want a car, and they want their kids to go to Harvard. And so before I sat down, because I knew that's why you're investing in China and emerging markets in the first place, is for that growth, right? But it was 8% was in that, and 80% was in companies that weren't even trying. And so pretty much for 20 years, I've been trying to work around and fix that problem.
And what compels you to fix that problem when there's easier problems to fix? I would gather.
That was the problem that I was tasked to figure out, and I just kept going, and I went down the rabbit hole, I guess, because I could immediately see there was a big problem, and and so what happened in the sort of first 10 years, I got from that moment, after I got the list, before I even sat down at my desk, that's what I saw. The index is broken. It's got all of these government companies, and it doesn't have that much in consumption. And it has a lot of these other legacy economy, the chaebol companies in Korea, and these oligarch kind of people and so forth. And so what I concluded pretty early is that you should just invest in the consumer sector, right? Because Burton and I launched a few China ETFs with Guggenheim soon after this,
Right.
that Invesco later acquired. But during the first 10 years of my emerging market life, if you will, I spent most of my time in Boston and New York with the family offices, endowments, and foundations like Harvard and Princeton and Yale and those kind of people. And I watched what they were doing. This concept emerged of somebody named it Emerging Markets 3.0. And the idea was, if you looked at how these sophisticated investors were approaching EM, it was evolving. And most of them had basically doubled their allocations in that period. From, in the case of Harvard, went from 6% emerging markets to 12%. But as they got bigger, they would get more targeted. And they wouldn't just buy the index. They would, for example, in the case of Yale, David Swensen, the famous endowment manager, he took his smartest Chinese analyst from the endowment and gave him a bunch of money and sent him back to Shanghai to start a private equity fund, which was a huge success, still a huge success.
Okay.
But most people couldn't do that.
No.
So when people would ask me, what's the best emerging markets ETF? I didn't tell them to buy one of my China ETFs, because that was just China. If you wanted all the emerging markets, I said, buy the emerging market consumer ETF, right? Leave out all the banks and the state-owned oil companies and all the corruption. Leave out the legacy economy and just tap into the thing that's actually emerging, which is a big deal. In fact, McKinsey calls the rise of the emerging market consumer the biggest growth story in the history of capitalism.
And in some of that research, I think it's really interesting, and I was keen to get your thoughts on this. Those consumers, they say the vast majority of their consumption will be of US-based products and services and goods, like your Coca-Colas and your Apples, etc. So, or will that benefit be felt by emerging market-based?
Oh, it's a combination. It's certainly not Apple products. This is the emerging markets is Android land.
Okay. Yes.
You need
the equivalent of, right? Yes. With US companies.
But yeah, I mean, everybody wants Nikes. Nike's the Nike of China, right? But want is the Nabisco of China. So that so there's some local competitors. Yeah. There's some global brands. Obviously, in the luxury, the European brands are largely are the luxury brands. So it totally depends by country, and that's part of the fun, I guess, of it. These are not homogenous places. India and China are different. Brazil is different than them. Kazakhstan's different than Colombia. So, but it is true that basically everybody wants stuff. I mean, and I had seen this pretty clearly when I got married in 1997. My wife and I went on a 5-month sort of trip around South America and Africa, and every single time almost every day someone asked me for one of my Nike hat. It was like gold. Like every single place, people say, "Oh, your Nike hat or your Nike shoes." They all wanted my Nike gear. So, this is, and you don't have to really stimulate this. People just want stuff, right? Especially when it's the basics like food and clothing and air conditioners, and as you move on up, you have more and more in disposable income, and you aspire to a lot of things, and so, the Apple phones are expensive, and so are Nikes. So, you have local brands. And in fact, let me use this to continue the getting to EMQQ. So people would call me and say, "What's the best emerging markets ETF?" And I said, "Buy Econ, ECON, which is the U.S. ticker for an ETF that owns the emerging market consumer stocks according to the Dow Jones Index." Okay, Dow Jones Emerging Market Consumer Index. Now, I have nothing to do with that organization. I didn't work there. I didn't know anybody, but because they were the first ones to make this emerging market consumer ETF, I knew about it. And because I knew that was the simplest answer to what's the best way to invest in emerging markets, I always told people to do that, because you can't start a private equity fund in Shanghai, right?
Sure.
And nor could almost anybody else in the world. And 11 years ago, I was in my car and my phone rang, my first iPhone, which was sitting on my car seat.
That's the first one?
This was my first one.
Yeah.
And it was a friend of mine, and my friend said, "What's the best emerging markets ETF for my 3-year-old for the college fund?" And this was in the spring of, or early summer of 2014. And I started to tell her to buy the emerging market consumer ETF. But then I stopped myself and I said, "Wait a minute. The best emerging markets ETF for the long term is different now. It doesn't exist." And I went back to my office and I started to work on EMQQ that afternoon. And I launched it 100 days later on the New York Stock Exchange. Because what I realized, there were two things that kind of led to that light bulb moment. First of all, even back then, or not even back then, I had noticed that all of a sudden there was a truck, a UPS brown truck, pulling up in front of my house once a week, then twice a week. Then I knew the driver by name. And we live east of San Francisco, and the roads are nice, and there's a Target store, a big box retail store that's a few miles away. And my family used to go there like 5 times a week, but all of a sudden the number of trips to the Target were going down, and I knew Mark, the UPS driver. And then there were other trucks, and I could tell what color the truck was from the sound of it even. So, but perhaps more importantly, the morning that I got that call, I looked at my own portfolio that I had of individual securities, and there was 5 companies that I was invested in, that all of them were emerging market consumer plays. And 3 of them were in the emerging market consumer ETF. They were Hong Kong listed Chinese companies, one a food company, the Nabisco of China, Want, crackers and snack foods. And then I had 2 Chinese sportswear companies, Li Ning and Peak Sports, which, as I said, Nike's the Nike of China, but you can call these the Reebok and Converse of China. So food and clothing. And those were all part of this emerging market consumer ETF. But I had these 2 other companies that were absolutely investments to target the emerging market consumer, but they were not in the ETF because the database called them technology companies. The Amazon.com of South America, called Mercado Libre, which trades on the NASDAQ, MELI, that was the main one.
Okay. I
also owned a Chinese local ads business, the Craigslist of China, if you will, which traded on the New York Stock Exchange. And when I looked at my 5 stocks that morning, I thought, well, the 3 that are called consumer stocks, I think they're great. They all have good brands, so I think they have a moat. They were growing at 15 or 20%. But then I looked at Mercado Libre and Wuba, and they were growing at 120% and had great margins. And while the PEs were high, when you put the PE over the growth rate, they were actually lower. They were cheaper than the consumer stocks. And that was the aha moment. And I came back here. And now it's fairly clear to me now what's happening. Because, again, even back then, every time they had, earnings season and earnings reports came in, you saw the same thing. Again, this is going back 10, 11 years ago. What's going on in the stock market? The FANG stocks are killing it and making new highs and growing like crazy. And here's a list of the traditional retailers that are going to go bankrupt soon. Sears and Kmart and, so again, this was right in our face. And it was clear that this device was changing how we consumed. And now it's pretty clear to me that it's actually a lot bigger than this, because what's happening in emerging markets right now with technology is probably if McKinsey is right, that the growth of the consumer in emerging markets is the biggest growth story in history. Well, this is by far the best part, because there's actually 3 mega trends sweeping emerging markets. One direction, global trends. And you and I are part of all of them, but we don't think of them as trends because we've been part of them for generations now. So the first mega trend is the emerging market consumer, right? When I was a kid, we had plenty of food and clothing and cars and took vacations. My brothers and I were the first ones to go to college. My children have now gone to college. But we've been doing this for a while now. Well, guess what? Most of the world's just getting started, right? That was how I started this journey, was that consumer. Now, as I mentioned, when I got that call 11 years ago, I answered it on this phone. So I had a smartphone 11 years ago, but I had a computer for 20 years before I got this.
Right. Yeah.
Well, most of the world is getting their first computer today. In India right now, 5 or 6 million people a month are getting their first ever computer. And it's not a desktop, and it's not an Apple product. It's an Android-based smartphone that gets better and more affordable every year. Today in India, you can get a brand new smartphone for $12. So the computer is the second mega trend. Mm-hmm. And then the third mega trend is something that I first got in 1995 called the internet, which I accessed on a telephone line with a modem in the San Francisco's Marina District in 1995. So we've had the internet for 30 years now. Well, guess what? Most of the world never even had telephone lines, let alone cable. So those 6.5 billion people, they're not only getting their first computer today, but the moment it's in their hand, they now have entered the internet age. And because the kind of thing that really takes the story and makes the slope even steeper in terms of growth is we've had a very evolutionary experience with both consumption and technology. These people are going from 0 to 100. They've never had a bank account. They've never had a credit card. They've never had a debit card. They have been 100% paper-based cash, most of them, okay? They never had a TV. They've never had a radio. They've never had a camera. They've never had all of these things that we have. And so there's this leapfrogging going on. And again, the most important part is the money, right? These people are going straight to mobile phone-based money. And the result has been that since I launched, the emerging markets internet sector has had average revenue growth of about 35% a year. Actually, it was already happening. So the last 15 years, the average revenue growth for the EMQQ index is about 35% a year. So I'm not positive of anything in the world, but I'm pretty sure it's the fastest growing sector on the planet. And I also believe it might be the fastest growing sector ever on the planet. And I've asked people like Burton Malkiel, who, has been teaching economics for 60 years in the Ivy League, and he doesn't know of any sector that ever did this. So either way, if you're going to invest in emerging markets, you want to invest in the internet companies. And the reason is not just because it's by far the best growth, but it also solves the other problem that's big in emerging markets, which is corporate governance. Because again, you have these state-owned enterprises, you have these, the chaebol in Korea. People probably don't know that the chairman of Samsung has been arrested twice in the last decade for, bribes and so forth. That would bribe the president of the country. You have things like the Adani Group in India, which has been under a lot of microscopes from the US short sellers. So corporate governance is like one of your biggest problems in emerging markets. The internet companies in emerging markets, they have the best corporate governance because this is how they start. The smartest kid I'm making this black and white, and I'm not an academic snob. I went to the University of Arizona and had a 2.0 GPA. So, but to make it simple, let me just describe it as this. The smartest kid from every country goes to Harvard or Stanford or Oxford or, name your fancy college. And after they graduate, they go work for Google or Microsoft or Morgan Stanley. And then they go back and get their MBAs at Harvard or Stanford or Oxford or, IIT Delhi or whatever. And then they start an internet company and they get funded by Sequoia or Tiger or SoftBank, right? And that doesn't guarantee better corporate governance, but if, the best institutions in the world are there at the very beginning and on the board and, their lawyers are creating the formation documents, that's a huge head start. Yes. Versus all the corruption you'll find in the average emerging market company.
Okay. And so you absolutely make a great case, and I'm a fan of having emerging market element in pretty much all portfolios. Some will say that whether it's technology or consumption or any other aspect or sector, that it's we've been waiting for emerging markets to emerge from a performance perspective for investors for a while, right? Particularly over the last 4 years. A lot of stuff is flat or indeed down, depending on the sector you're in emerging markets. Some will say, well, when will we see it actually emerge, right? When will we see returns on what we're doing? Because there's been a large disparity between what the rest of the world has generated from a performance perspective.
Oh, no. And again, this is the reason I started my business. This is what I've been trying to solve from the beginning. When people look at emerging markets, what they're looking at is the MSCI Emerging Markets Index. That is the index that is the leading index. Now, Vanguard's funds sometimes track the FTSE emerging market, but they're essentially the same thing. The MSCI, however, is the institutional standard. So the MSCI index is the biggest value trap in the world. It looks really cheap. People look at it and they go, oh, look, it's 10 times earnings. And emerging markets are growing so fast, this is a bargain, right? The S&P's selling for 25 times earnings. So it's half price. Well, the revenue growth in the last 10 years for emerging markets is negative. The earnings in the last 10 years have declined, right? The index is broken. The index, the reason you haven't made money is because the companies haven't grown their value. There's no earnings growth. And so, but people don't look under the hood. That's, another problem. I'll see a chief investment officer from a, $1 trillion asset manager, and they'll say, well, we're getting really bullish on emerging markets, and the PE is 10, and, their GDP growth is twice the developed world. What a bargain. Well, if you knew what the Agricultural Bank of China was, or Petrobras, 10's probably a rich PE for it. So again, this is why I made EMQQ, because the traditional way of investing in emerging markets, you're not going to make any money if your earnings don't grow. And in the last 10 years, at least, they have not only not grown, they've gone down. And there's nothing, I think, in place to change that. So meanwhile, the internet space is where there's a lot of growth. And another thing I didn't touch on, most of the internet companies aren't in the index. So if you buy the iShares or Vanguard emerging market ETF, you don't own Mercado Libre, which is now the largest company in Latin America. It's by far the best performing stock. It dominates not just e-commerce in Brazil and Mexico and every other country. It's also the brokerage firm and the bank, Mercado Pago. Their financial services business is actually just as valuable as their e-commerce. So imagine if everyone in the US had their stocks and ETFs at Amazon and got a loan from Amazon and had an Amazon credit card. That's what Mercado Libre is. It's by far the most consistently dominant internet company outside of the United States. It's up thousands of percent. It's not in the index. You know what the two biggest positions are in Latin America if you buy iShares or Vanguard? Petrobras, the corrupt oil giant, which was looted for 10 years by a third of their congresspeople and two of their presidents. The second biggest holding is also Petrobras preferred. So you get two doses of the most corrupt company in the world, and you don't get the most entrepreneurial company whose business plan was written in the Stanford Library in 1999. Okay. So this is the other problem with the traditional approach. Most of the internet companies are missing.
So with EMQQ, what type of performance have investors experienced?
Okay, no, this is a good question. The first 7 years were really good. Let's start with that. 4 years ago, what's that?
The 21 or so, was it?
Yeah, 2021. 4 years ago, if you had stopped the clock then, we were number one in the world by a lot in terms of emerging market performance. So the 1 year, 3 year, 5 years since inception, we were number one, and we were well ahead of whoever number two was. And in the middle of in the middle of February 2021, we began a very painful and long crash, basically. Now, to be fair, during 2020, we were up over 80%. And part of that was because people realized, well, with the COVID, everyone's going to have to buy stuff on their phone. So there was a COVID boost to e-commerce, and it got a little frothy. And there was other things in the markets, the memes and SPACs and those kind of things. And then in the first 6 weeks of 2021, we were up another 25%. And, I don't know how to time stock markets, but I certainly, that's not a normal kind of move, and it felt a little hot. And so I wasn't surprised that we lost a little of that. But what then followed was a combination of worst case scenarios that brought us down about 80%. I mean, it was pretty brutal. And the first was that interest rates went from nothing to 5%. So the risk-free rate became a real issue. But then you had these two simultaneous negative headlines about China. You had the delisting of the ADR threat, and then you had the China tech crackdown / Jack Ma's missing. And these two storylines, for a 2-year period, every week, they were on the front page. And it was a challenge for me because both of these were totally ridiculous things, and neither of them really represented a risk in my pretty knowledgeable position. The delisting thing was completely ridiculous and was never going to happen, and it did get resolved. Part of the reason it didn't get resolved faster is because the accounting watchdog in the United States was maybe the most dysfunctional part of our whole government, and all of their executives and the board had been fired by the SEC when the Chinese were trying to resolve this. That took them 9 months to replace them. And finally, the new people went to China, and they resolved that issue. But no one knows this because that doesn't make the headlines, right? People still ask me, what about the ADR delisting risk? Now that could come back up as a new risk, but that initial one was not real. And then you had this idea that Jack Ma was missing, the Ant Group IPO, and I supported the Chinese government in every one of those things. They had to stop the Ant Group IPO because they were going to change the financial laws because, Alibaba, the Ant Group, which is Alibaba's financial services business, it was incredibly profitable, but most of the profits came from making loans outside of the regulated financial system. And so rather than have them go public and then change the laws, which were going to change their profits, they said, don't go public because we're not regulating you properly, right? Because one of the challenges with the internet has been regulations have been trouble keeping up with it. And we've seen that when Uber came to London and the taxi industry was up, so all over the world, the governments have been trying to catch up, and I applaud them stopping that. But either way, you had this negative timeline over and over and over, and it became uninvestable, right? So to answer your question, the first 7 years were great. Then the 3 years of misery. And now I think we're going, in the last couple of years, we're going back the right direction. And this particular calendar year, China's finally, gone from being uninvestable to maybe it is investable. And I think that's still early on the reacceptance of China as part of the investment world.
And do you think that acceptance, if it does come true, will be a driver of growth? And I see more and more. I do watch what's going on in America and what financial analysts and advisors are saying from America, and there's a real push on the rest of the world outside North America, right, for American investors to look outside the world and diversify emerging markets. Europe has obviously had a great year, and as have parts of emerging markets. So what do you think is going to drive that growth? Is it those mega trends? Is it political? Is it geopolitical? Is it sentiment? Is it what media are saying? Or where is it going to come from?
It's all those things. And at this literal day and time that we're sitting at right now today, it's probably one of the most anxious times the world's been in economically, because we have a new president and he's doing a lot of things, and some of them are disruptive. But it's important, where President Trump and his administration stand on tariffs and tariffs on China, tariffs on Mexico, the relationship with China, the relationship with Europe. And so, nobody has an answer to this right now. And the answer changes, every time you refresh your Bloomberg homepage, there might be some new piece of news that is big and important. But here's what I think right now. In terms of China was so far out of favor that I had never seen anything like it. It literally became uninvestable, at least in everyone's mind, which was ridiculous. And that's not even a word, by the way, uninvestable. But of course they were investable. And if you didn't want to invest in them, or you thought they were a bad investment, that's one thing. But when every single person thinks that, of course the prices were dirt cheap, right? It wasn't just capitulation. It was like, we don't even include China anymore. And so the valuations got really cheap. Now, China does have a real problem with this real estate situation, but the internet companies, the Alibabas, the Tencent, these things are massively profitable. They were building up piles of cash. And so a lot of them had half of their market cap in cash. And a lot of them were actively buying back billions and billions of stock. And so finally, when this DeepSeek AI thing, came out and kind of shined a positive light on these companies, and, because AI has added so many billions or trillions of market cap to our US tech sector, and this DeepSeek, which isn't a public company, of course, but it did had a breakthrough that maybe said we don't need all these expensive NVIDIA boxes or what have you. people looked at Alibaba and Tencent and Baidu and said, well, these have AI as well. And in fact, not only do they have AI, but they were in rapid fire getting ready to launch certain things. So you saw the day after DeepSeek that Alibaba released its Qwen 2.5 technology. And within a couple days, the Apple iPhones in China, it was announced Apple was going to use Alibaba's AI in their phones. Baidu, which is the search engine, the Google of China, they have a self-driving taxi fleet that's twice as big as Google's Waymo, about 2,000 cars, and Waymo's private, but its last valuation was 45 billion, and Baidu's entire market cap was only 30 billion, and it also had 15 billion of cash. So anyhow, this DeepSeek thing shined a light on China. And again, I don't make short-term stock market predictions, but my kind of gut feel is that they've had a big move this calendar year. The Chinese, internet companies are up, but they were so far out of favor that there's still, I think, a lot of room for them to be welcomed back by the investment world. Remember, when all this stuff went down, all of the money that went into emerging market funds in the United States went to emerging markets ex-China. I mean, that's how bad it got in terms of people throwing away this country. And look, I also think, and this is completely speculative, but I think that Donald Trump may surprise people with what comes of the China relationship. I believe that Donald Trump is going to try to work out a relationship with China that's not as, there's certainly going to be tariffs and things, and we're certainly going to compete with them, but I think he's still going to take a lot less confrontational approach with Xi Jinping. And he has said himself in December, one of the things that first made me sit up in my chair was a comment he made at the end of a press conference when someone asked him about Xi Jinping, and he said, Xi Jinping is a great man. And then he said the following. This was Donald Trump said this. He said, the United States and China, if they work together, if you think about it, can solve all of the world's problems. That was Donald Trump. Now, I don't think that's true, but he can certainly help the sentiment of investors as relates to China, because all the fear has been about the U.S. and China. And the other thing with that relationship is, at least today, Elon Musk is still a pretty big part of, the people influencing him. And when everyone said China was uninvestable, Elon Musk was putting billions of dollars into the ground to build, Tesla's, mega factory in Shanghai, and has been the most successful foreign entrepreneur to go into China. He raves about the work ethic and the engineering talent. And so, we'll see. He's also said he wants to go to China in his first 100 days. So I'm actually pretty optimistic about the China, stocks in the near term.
And India is been a bit shaken in the last probably 5 or 6 months in terms of sentiment and potential fears. And I suppose this is something that can happen to any country or any region ultimately. But what do you think is happening there, and what's your views long term for it? I guess you're bullish long term on.
No, let me let's talk about India, because India is a very special situation, and for long-term investors, this is as good as you're going to get, I think.
Okay.
And so let me and as you pointed out, there've been a significant correction in the Indian equities, which essentially peaked in late September. But let me first tell you why I think India is perfect. I mean, India is the perfect emerging market. I don't think that's really debatable, and here's why. If you if you go back to the list of like, why are we investing in emerging markets in the first place? Number one, they have a lot of people, 90 or 85% of the world's population. They have better demographics. So they're, of the people under the age of 30, they're 90% of the world. They have faster growth. The GDPs are growing a lot faster than the developed world. They're actually bigger than the developed world economies now. And that's driving consumption, right? The biggest growth story in the history of capitalism. So if we take that checklist and we map it over to India, it's not even the question that India is perfect. So first is a lot of people. India has the largest population in the world. Okay, it passed China 2 years ago. Today, India set a record as the largest population ever on the planet. Tomorrow, it'll set a record as the largest population ever. And every day for decades, on that day, India will be the largest population ever. China's demographics have caught up with it now, and so it's not going to fall off a cliff, but it's not growing. So, and if you leave out China, India is bigger than every other emerging market combined, right? The next on the list is Indonesia with 280 million people. So, 1.5 billion to 280 million, that's a pretty big drop. So check the box, a number one, right? Not just pass, but a number one ever. Demographics. India's average age is 28 and a half. The dependency ratio is incredible. There's 750 million people under the age of 30. So it's number one in that category. It's got the fastest growth, 6.5% GDP growth, the fastest in the world. And that's driving the same thing we saw in China in the last 20 years, which is consumption. And so this booming consumption class, and if you take all those figures and you project out, as the OECD has done in a study, India is going to pass China and be larger when it comes to consumption, and actually even meaningfully larger in 20 years. So on paper, India is as good as you're ever going to find. Yeah. Now, then the question is, okay, well, where has India been? Why is India here all of a sudden? Why has China been here for a while? Why is India just showing up? Well, the main reason is leadership. Prime Minister Modi is basically in his 11th year, and he's at the beginning of a third 5-year term. His first 10 years, which started in 2014, he has changed the country in a meaningful way, and he's running the country like a business. Right out of the gate, he came in with a machete to help chop out all of the bureaucracy that is holding the country back and has been since the British left. Now, they're not done, but he is cleaning things up and making it easy to start businesses, making it easy to close a business. Before Modi came, they used to call it the license Raj, where if you wanted to start a business, you needed to get like 20 different licenses, and every one of them wanted a bribe, and you had all of those issues. So he's just streamlining the place, and he doubled the infrastructure. And this is a big deal, because when I got involved 20 years ago, China and India were almost exactly the same size. But China, with a one-party system, was able to build the world's greatest infrastructure. India, with its bureaucracy and socialist elements, they couldn't even get the power to work. And so obviously it's hard to attract, manufacturers when the factory grinds to a halt in the middle of the day and you don't know when it's going to come back online. So in 10 years, he doubled everything: roads, highways, bridges, everything, every piece of infrastructure. And they're not even close to done. They have $1 trillion master plan that includes building their own high-speed trains. The British left them a lot of train tracks, but they finally have electrified most of it, making their own high-speed trains, connecting the cities, tripling the number of airports. One of the first luxuries is the $19 plane ticket. And so the number of people, first-time flyers in India, is like a huge growth opportunity. But the airports are strange. So they're literally tripling the number of airports in 10 years. And then they're building ports to unload cargo, including a massive one outside of Mumbai, which will be a real game changer. So they're finally addressing that issue. Okay. So on paper, India is perfect. You've got this leader who's been just doing a great job. Not everyone loves him, but he's pretty popular. And he's just running the country the right way. He's also 10 years younger than our president, and he's in good health. So, he should be around for a while longer. Now, so right there should be enough to say, okay, this is the best emerging market. But then there's two other things that India has. The first is India has a technology sector that's older than I am. Okay, you have an ecosystem of technology in India that goes back to 1968 when Tata Computer Systems was founded. You have publicly traded companies like Infosys that's been public for decades. These are the companies that outsource, technology jobs from the developed world. But you have this ecosystem of billionaire founders, publicly traded companies worth tens of billions of dollars. They've employed 1 million or more technologists and managerial talent. So, you're not going to find that in Vietnam or Indonesia. You have an educational system at the top that includes some of the world's greatest colleges, the Indian Institutes of Technology, the IITs, which are modeled after MIT. There's 23 of those institutions. There's also another 21 business schools, the Institutes of Management. So you can think of the Stanford Business Schools of India. And the amount of talent that comes from these organizations is unmatched. If you look at the S&P 500, there are 25 CEOs that are Indian in the S&P 500, including Google and Microsoft.
Yeah.
So you're not going to find 25 CEOs from any other country than the United States in the S&P 500. So, and what is very important is that historically, the best Indian talent left the country. They wanted to work for Google. They wanted to work for Microsoft. In the last 7 years, the number of startups in India has gone from 500 to 120,000. So entrepreneurism has been unleashed in the population. They have their own Shark Tank now, season 4. And so this is hugely important. You're not going to find this there's no developed country that has the kind of talent that India has, leaving out the United States. So you've got that X factor. There's obviously a lot of other, Indians in high places like running the United Nations and certain cities and countries. And then the final thing that India has, which nobody understands. And I talk to a lot of investors, and I have yet to meet one that knows about the India stack, India's proprietary digital public infrastructure, which sounds very boring, but it's not. And it's incredibly powerful. Are you familiar with the India stack?
Familiar with the India stack.
Do you know what digital public infrastructure is?
I have a broad idea of it.
Well, digital public infrastructure, as it sounds, are things that are digital. They're free, as in they're public. And they're like the pipes for the information age. The best example is called the internet. I didn't make the internet. I don't even really know who made it. But I use it every day. I don't really see the internet. It's there, but so that's what digital public infrastructure is. The other good example is GPS. Right? I didn't launch a satellite. I don't get a bill from GPS. Doesn't send me a bill every month. I don't know how it got there. But you have companies like Uber that couldn't exist without that, or companies like Google that couldn't. So again, these are like the infrastructure for the technology age. Okay. So India, of course, has the internet and GPS, but it's also got some of its own that is amazing. So let me just give you a quick tell you about the stack and how it came to be and what it actually does. The foundation of the stack is called Aadhaar. The reason it's called a stack is if you make a picture of these different pieces of infrastructure, it looks like a stack of pancakes. The first layer, the foundation layer, is called Aadhaar. which is the Hindi word for foundation. So the foundation of the stack is called the foundation. And here's how this whole thing got started. In 2009, the Indian government approached the chairman of Infosys, a man named Nandan Nilekani, who's one of the co-founders of Infosys. And they asked him to be in charge of a program to give everybody in the country a national identity card, a physical card like a driver's license. And this was a big project, and it was something they needed very badly, because one of India's challenges in developing was that only about 20% of the population had any identification. So 80% of the people couldn't prove who they were. Less than half of the people even had a birth certificate. So there's still a lot of people have no idea their birthday. Okay. So, and as you can imagine, it's hard to formalize your economy when this is the situation. So finally, they decide to address it and launch this national ID card program. Physical card, your picture, your name, your information, and your own 12-digit number. Okay. Now, they asked this man, Nandan Nilekani, to lead this program, to do this as a public-private partnership, but not for profit. He accepts the job, but he insists that not only will they give everyone a physical card, but when they sign up to get their card, they're going to scan their fingers and their eyes so that every person that's in the database can also be instantly verified without any paperwork. Okay. They launched this in 2010. And now I didn't pay attention to this until 4 years ago. So I knew they launched this, but I didn't pay much attention. And then a few years after they launched it, they added another layer to the stack, or a piece of functionality to the Aadhaar program, I would say, a know your customer layer. And they started a program with the banks. And they said, if you're registered and you've signed up for your card and had your finger scanned, you can now walk into a bank and open a bank account with no paperwork. Today, the entire country is in this database. 95% of the population has gotten an Aadhaar, has a physical card, and can be verified instantly with their thumb and their eyes. 800 million people have walked into a bank and opened their first ever bank account in 2 minutes with no paper. So you took the entire population, the entire economy was 95% paper-based, okay? And you brought every single person basically into the financial inclusion at population scale in a digital-first fashion.
Impressive.
Using this Aadhaar database. Now, the stack is called open API. So just as Uber can use GPS, businesses can use Aadhaar. So, and what happened in 2016 was a combination of things that have really sent India into this incredible digital growth story. So they passed 1 billion people in the database in 2016. Then in September, Reliance Industries launched the first 4G network in India. Okay. The mobile carrier market in India was fragmented. There was 12 different competitors, all of them on 2G only. None of them had enough money to invest in 3G because it was a constant price war. Jio comes in with $25 billion, buys the 4G airwaves, covers the entire country with brand new state-of-the-art hardware, ready for 5G and 6G. If you went into the Vodafone store back then and you wanted to get a new phone, it would take at least 3 days, at least 3 hours, maybe 3 days, maybe a week. Jio used the Aadhaar database, and you could walk in and get a phone in 5 minutes. They signed up 100 million people in 100 days. There's now 500 million people. So you've used this biometric database to bring everybody into the digital banking system, give everyone now 5G access and the cheapest data in the world. And then they added a payments layer on top of that. The second layer, which launched in 2016. It's instant free payments. I send you 1,000 rupees, it's instantly on in your account.
It's impressive.
And now it's more than half of the world's instant payments. And the entire economy in 7 years went from 95% paper-based to 80% digitized.
India, I'm a fan. I see, and what you're saying is really impressive. And I see the growth of, let's say, even an Indian, a Vanguard India index, for argument's sake, Granite shares, is up the equivalent of what a global index is up in the last 7-8 years, 70% territory. In terms of identifying technology companies or internet companies, more so to your area of expertise, that will benefit from this massive progressive approach. How have you fared in that, and how do you go about doing it into the future?
Sure. Well, when we launched 10 years ago or 10 and a half years ago, there was only 2 Indian internet stocks in the whole world. And 4 years ago, there was 2 internet stocks from India in the whole world. But during 2020 and 2021, there was about 25 IPOs. So India's internet companies are finally started to go public. So now they're accessible. All of them except one trades in India. So they're not easily accessible for most investors. It's pretty straightforward. I mean, it's the same things that we've done in China and in Latin America. It's e-commerce companies, it's food delivery companies, it's online travel. You want to Make My Trip is actually the one that trades in the United States, which has been public for 10 years. So we've owned that from the very beginning. The Sephora of India, the different payments companies. Online brokerage firms. It's the same things we're using. It's just the localized version, and there's a whole bunch more coming. I mean, there's a lot of unicorns that will go public in India in the coming years.
So with your that area, have you had overperformance versus an MSCI India, right? A whole of market, massive overperformance because you've been picking and you've been in that area, or no?
Well, it depends on what time frame you look at versus the index. As I mentioned, there was a crash in the emerging markets internet sector that in 2021, and India was involved in that crash as well. So not only did India have a bunch of IPOs, but it also had a bubble, and that bubble burst in November of 2021.
Yes.
And the Indian internet stocks as a group dropped about 80%.
Wow.
Now, we didn't launch until April, so we missed the beginning of that, but the first 12 months, we were down 50%.
Okay.
We didn't really have any investors, luckily, other than myself. But
later on.
So since inception, we're still behind. Last year, we had the best performing strategy in all of India. We beat all the other indexes for calendar year 2024.
Okay.
But there's been a sizable correction in India. Yes. And in fact, I'm when I get off the phone here, I'm going to go push a send on an email, somewhat pounding the table, because the correction is pretty significant. I think we're down 22, 23% since early December.
But the fundamentals, I presume, remain. Look at these mega trends, long-term growth. It's not a short-term strategy, I'm assuming, right? It's a
well, I mean, it certainly shouldn't be. I mean, some people buy ETFs for short-term reasons, but if I created everything we do for people that have a long time horizon, which is how you do it. 5, 10 years or more, and there is no place in the world that offers the growth opportunity that India does. It's so early in India, and it is. I guess it's important to understand that India's half of its population is sort of a frontier market, right? You've got like 750 million people that are making $1,500 a year, which is frontier, sort of levels. You have another 750 million people making more than that, and certainly some people making a lot more than that. But so it's early in almost every direction. And so there's a greenfields nature to the Indian internet opportunity. And let me give you a couple examples. In fact, let me give you the best example. There's a company called Zomato, Zomato, which is one of our main biggest holdings and was also one of our best performing companies last year. And, what I tell people is it's the DoorDash of India, or I guess in Europe, maybe you'd say the Just Eat, right? It's the food delivery company. And that's their main business. Zomato's brand, their food delivery business is number one in the country. It's got almost 60% share of the market. But when Just Eat or DoorDash showed up in the developed countries, we had plenty of restaurants, and the restaurants had plenty of suppliers selling restaurant supplies. Well, everything is green fields in India, and so not only is it the leading food delivery company, but a year and a half ago, I would have told you that the most exciting part was their restaurant supply company called Hyperpure, which was the fastest growing part of the company. So that's a whole nother, massive opportunity to address restaurant supplies. Well, now there's another business that is probably the most exciting e-commerce story on the planet today, called quick commerce. Quick commerce is 10-minute delivery of anything, with an asterisk, of course. And Zomato has a company called Blinkit, Blinkit, which is part of Zomato. It's a company they acquired 3 years ago that is the quick commerce leader, 10-minute delivery. And let me tell you how this business works. And this is going to be, it's already a big deal in India, but the scale of this is, I think, going to blow people's minds with it.
I'm interested, yeah.
So quick commerce, basically, what you need for quick commerce to work is dense cities,
check,
low-cost labor, and mopeds and motorcycles, two-wheeled vehicles, okay? And the way it works is you're going to have an app. You're going to, of course, put in your location. And every neighborhood, about every half mile or mile, there's going to be a micro warehouse, a miniature warehouse, a dark store. And it's going to be right on the street next to the regular stores, perhaps, but it's just a miniature warehouse. And it might have 5,000 items, okay? You're going to open the app and you're going to, it's going to display some things right there that it thinks you might want or order again or whatever. And you're going to push a button. And that item is going to get put into a bag in the warehouse that's, in your neighborhood, basically. It's going to be in a bag in 1 minute and 40 seconds. And a delivery driver on a scooter is going to grab it at the dark store. And because you're less than a mile away, he's going to scooter over to you and drop it off. So what you've done is reimagine the last mile of delivery. And at night, when there's no traffic, you're going to restock the dark stores. Okay.
I remember hearing a story about, was it the Dabawalas? Are you aware of Dabawalas? It was in India. It was the way lunch was ordered and delivered by laborers. It was all delivered.
Oh, yeah, of course. Yeah.
Delivered on bicycles and all this. It was really efficient. It's like an e-commerce version of that almost as well.
There's some interesting things. Like, well, let's stick with Zomato, and then we'll come to another company that
we've got time now for you as well now, right, Kevin? But yeah, absolutely. I'd love to hear about that. About Zomato there, please.
Yeah. So this quick commerce it's eating India, because here's what India has that makes it so ripe for this. Right now, 95% of the consumer spending is at 13 million mom and pop stores. Okay, the Kirana stores. 13 million stores, and each one of it has 150 or 200 items, right? And it's a mom and pop, and and it's there's one on every block, right? but there's a lot of layers in the distribution to get those people their products. So now the dark store shows up. It's got not 150 items, it's got 5,000 items. And you can get it in 10 minutes, and it might be cheaper than going down the street to the Kirana store. That's a $550 billion a year segment. Okay. And this quick commerce, it's going to grow 600% in the next 5 years. And it will still only take about 4 or 5% of the Kirana business. So, and it's also, and this is one of the things that in a technology company that the venture capitalists get excited about. This is changing consumer behavior. And they're finding all sorts of other, because you have the data on what people want in the neighborhood. So you can hyper customize the inventory in each store. Mm. You can have seasonal offerings. It's Diwali. Oh, you want gold bars to give away, or Blinkit has 10-minute private ambulance pickup, which I just saw a post. This woman today was posting on social media how it saved her. Her father was saved by Blinkit's 10-minute ambulance. So anyhow, this quick commerce thing is a super exciting part of the India story. But my point is, it's green fields in every direction for the Indian internet companies.
Interesting. So watch this space with regards to India. Kevin, I'm conscious of time. We're going to need to...
Yeah, I know.
Now, we've gone way over time for you, so apologies. But the two quick ones, you mentioned that your EMQQ, FMQQ, and INQQ are available in US and in Europe as UCITS funds. And I'm out of curiosity, how, maybe you're not involved on this side of things, but how do you find Europe to deal with, and regulation of the UCITS and the ongoing obligations and stuff? Just out of curiosity, as a manager and an owner and runner of fund.
No, sure, and timely. I'm actually I'm flying for a 2-week roadshow on Friday. I'm coming over to Europe. Okay. So we launched with there's a white label ETF provider in London called Han ETF, and we were their first client with EMQQ. And we actually don't have FMQQ as a UCITS. We do have EMQQ and INQQ, the India one. And it's been great. And that's the part of the beauty of the Han ETF and that white label business model is I didn't have to do much of anything. They know all the regulations. They set up all the accounting. They have people in Dublin, for example, and so I just show up, and their salespeople, and I'll meet them in Verona on Monday morning, and we'll go to Bologna and Ravenna, and then to Milan, and I just show up, and they have meetings, and I'm talking at a couple of conferences. So it's actually quite enjoyable, and I like the European investors. They're not as well, they're different than the American investors.
In what way?
Well, I think that American investors are a little more extreme, especially as it relates to China.
Okay. Yeah.
In fact, I remember the last time I was in Europe, people were saying that they were getting warmed up to China, which nobody in the United States said until the stocks went up. Then they warmed up to them.
Yeah. No, look, it's probably historical reasons for some of that as well.
Yeah.
Everybody that we interview for a conversation here, we ask them for a book recommendation or to share a book that really stood out for them or that they really enjoy. If you hear growling in the background, it's my dog.
I saw him a couple times moving around.
You must see another dog out there traipsing around his turf. But we ask everybody for a book recommendation or to share a book that they really enjoy or stood out for them or stands out for them on an ongoing basis.
Well, let me say too, first of all, a random walk down Wall Street because, when I graduated, they told me to go buy that book, and it is. Yeah.
Yeah. Super.
So before I started on day one of my job, I read that book, and that, so that one I always recommend. And then this isn't a business book, but because I'm going to Milan, I was talking to a friend of mine, and there's a book that is based in Milan called Beneath a Scarlet Sky. Okay. That is I don't read a lot. Well, this is actually a nonfiction book. It's a true story, and it's fascinating. And if you, I spent a decent amount of time in Milan and around that area, so it's set in World War II, Milan, and it is a true story, and it's amazing, and I get goosebumps just thinking about it.
Awesome. It sounds like a John Grisham title or something, Beneath a Scarlet Sky. But as you say, it's a non-fiction. So yeah,
It's a true story. It's
there
a
you
true
go.
story.
Brilliant.
An amazing true story of one man's life.
And speaking of amazing story, I think it's really really interesting to see what the emerging markets and particular sectors of it will bring for us in the future. And you're certainly advocating for a lot of that. So I wish you and EMQQ Global and your investors the very best of luck. And thank you for joining us, Kevin.
Thanks for having me.
Excellent.
Okay.